How to decode earnings reports, a 3-step guide to spot real gems. Have you ever noticed something puzzling with US stocks? Sometimes a company crushes earnings expectations, yet its stock tanks. Other times, mediocre results trigger a rally. What's really going on? How should we interpret earnings reports, and which metrics truly move the needle? Welcome to Genius Finance Talk. Today, we're breaking down a simple, practical, and reliable 3-step method to evaluate any US stock earnings report. This works for most companies. Save this video for later, and don't forget to like and subscribe, your support means the world. Step 1. Focus on the trend, not just the headline numbers. Many investors only check whether revenue and EPS beat estimates. That's not enough, it can even be misleading. Take Circles this quarter, both numbers looked stellar, but the profit was a one-time boost. Despite smashing expectations, the stock dropped 12% post-earnings. Generally, we assess trends from 3 perspectives. Revenue trend. If revenue shows year-over-year growth for 3 consecutive quarters, the business is accelerating. Beating estimates on top of that fuels even more bullish sentiment. If revenue growth slows for over 2 quarters, be cautious, especially for high-growth tech firms. Sentiment can sour fast. Gross margin trend. Gross margin is a sensitive gauge of competitive strength. Rising margins suggest better cost control, stronger profitability, and some pricing power. Nvidia, for example, maintains gross margins above 70%, highlighting its dominant position. Its rival AMD stays below 50%. Conversely, declining margins often signal intensified competition or rising costs. Even a revenue beat might not save the stock if margins fall sharply. Free cash flow, FCF, trend. This is one of Wall Street's most trusted metrics. Earnings can be massaged, but cash flow doesn't lie. Growing FCF means the company is genuinely profitable. Shrinking FCF raises red flags about high operating costs or sustainability. Look at Oracle. Despite signing a massive deal with OpenAI, its weak cash flow makes investors doubt its ability to fund heavy AI investments. The stock has struggled as a result. Step 2. Watch the guidance, the market looks forward. Stock prices typically reflect expectations 6 to 12 months out. When you buy a stock, you're buying its future. That's why next quarter and full year guidance are so critical. If management raises guidance, it's a powerful bullish signal. If they cut guidance, even a stellar earnings report might not prevent a sell-off. Step 3. Read between the lines, the why behind the numbers. Don't just scan the figures, dig into management's commentary during the earnings call. Listen for changes in competitive landscape. Updates on future investments, e.g., AI, R&D. Shifts in customer demand or market share. Also, watch insider trading activity. If executives are buying shares after results, it signals confidence. Heavy selling? Not so much. Wrap up. Trends over headlines, check revenue, margins, and cash flow trajectories. Guidance is king, it tells you where the company is headed. Context matters, understand the story behind the numbers. Master these 3 steps, and you'll cut through the noise, making smarter, more confident investing decisions. Subscribe to my channel for more insights. Stay sharp.